Harindra de Silva, Analytic Investors, runs a number of quantitative strategies from covered call to long short. So which was the best strategy so far in 2015, and what are your expectations for 2016?
Well, the best strategy we run this year has been our Analytic Global Long Short Fund. This is a strategy where we're short high beta stocks, so it's really profited from the high volatility we're seeing in the market this year. My expectation is that this volatility is going to continue, so I would think a strategy such as this will continue to do well next year.
All right, and in that fund, I'm talking about the 361 Global Long Short Fund, which is what you sub-advise. You're long right now consumer discretionary, healthcare, and tech. Do you think these are also going to be the winners in 2016?
Those sectors of the market we think will continue to be low beta, will continue to have much more consistent performance than the other sectors that we're short.
Is there something about the current economy which is giving them low beta?
Some of these sectors, like healthcare, for example, have consistently been low beta. Consumer discretionary is not always low beta, but it tends to be low beta in the recovery stage of economic cycle.
And on the short side, you're short materials, energy, and telecom. Same expectation for 2016?
The same certainly for energy. The beta of energy stocks is very, very high as a group. That tends to continue for a 1 to 3 year time period or so. So I would say that sector I'd be a lot more bearish on. The other two sectors, the beta is not as negative. It might turn to be positive, less than 1 beta.
Do you expect volatility to ramp up a little bit more because we're going to see those Fed rate hikes hit in December, and then I know they're going to telegraph them, but we're going to see higher rates in 2016?
You are going to see higher rates. You're going to see a maturing of the economy. We're now 6 years into the recovery. It's one of the longest recoveries on record. And I think both those things are going to contribute to higher volatility in the market and benefit a strategy that shorts high beta stocks.
All right. So once again, why is this a good strategy for investors to go long low beta and short high beta? I mean, I guess it makes sense, right? You want to sell short the high valued stuff and buy the cheap stuff?
Yes, because in the long run, high beta stocks have shown dramatic underperformance to the market. Because high beta stocks tend to be valued like lottery tickets. I mean, the typical high beta stock has a PE of 30, and it's expected to grow at 20% a year. That never comes true, which is why shorting high beta stocks is a great way to protect your portfolio.
And how do you protect yourself from a short squeeze? Because you're not the only one recognizing that a stock might be overvalued.
Great question. The best way to protect yourself is to diversify. We have about 50 stocks that we're short, to diversify across industries, across different types of sectors. So you never want too large a position in a high beta stock, because there's always a chance of a takeover. There's a chance that one of the lottery products they're coming through will actually come through. So for that reason, you really want a diversified short portfolio.
All right. Well, thanks a lot for coming on and talking about it, Harindra. And thank you for watching The Street.